Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on January 10th. My name is Ian Saunders and joined again here by John Lewis. John, good to have you back on.
Yep. Ian, good to be here. Thanks for having me. Should
Yeah,
be
for
good.
those who might not be as familiar, of course, most probably should know who John Lewis is, but he's the head portfolio manager and head of the research team here at Nasdaq Dorsey Wright. John, how long have you been with Dorsey Wright? I don't want to date you, but
Now you're trying to make me feel old. So I started at Dorsey Wright in 2002. So it's been a minute.
it's been you've seen a lot of movement over the years, that's for sure.
Yeah, I've seen some ups, seen some downs. So
Yeah.
yeah.
Hopefully more ups. And so John lives out in Pasadena, California, at the money management office out there. So thanks for taking some time away from the smoke here to hop on with us.
Yeah, I mean, if I smell like I've been smoking all day, it's not actual smoking. It's just inhaling the smoke from the wildfires.
Well, hopefully, at least at this point, I don't think smells can come through the podcast. Maybe that's the next future AI iteration that we'll see down the road.
Yeah,
Um,
no one wants this. No one wants this campfire smell. That's for
no one
sure.
wants the smoke, pun intended. That's
Yeah.
but definitely good to have you on. We'd like to have you on kind of periodically, get your take on what's going on, and it's especially timely as we're kicking off the start to a new year. You did a webinar yesterday with Miles Clark, another member of our research team, that looked at a lot of some of the stuff Miles and I talked about last week on the quarterly report. But there's a lot of good content in there around just kind of market outlook stuff. And John, we're coming into a year, we're following a year, two pretty good years for domestic equity returns. And last year, especially, I mean, we had the S&P up 20% back-to-back years, right? But the past year, 2024, was a little bit better for momentum than the prior year in 2023. Is that right?
Oh yeah, I mean by far and away. So last year was a really, really good year for momentum in terms of outperformance versus the S&P, like kind of best year since 2020. So it's been kind of a long time coming in domestic equities anyway. And so it was really nice to see momentum really perform well last year.
And when we're seeing it, so we were talking a little bit, I think there's a piece in that quarterly report around I guess, when momentum has momentum, when it picks up the pace. Is something like that, is it, does it tend to go up and turn around and go back down? Obviously, we don't have a crystal ball, or is that tend to have more kind of staying power historically? What does that kind of look like?
Yeah, no, I mean, it tends to have more staying power than people think. So just because we've had, one good year of momentum doesn't mean that all of a sudden it has to turn around and we're going to get brand new leadership or anything like that. Certainly that could happen, but historically speaking, when you've had a really good year of momentum, it does tend to continue into the next quarter and then also into the next year. And we had some stuff in the webinar, and there's been some stuff put in the daily equity report about that as well.
Yeah, it's I mean, I think you had a line in the slide in the webinar, just looking at even, I mean, outside of some of our indicators and research, but just looking at like a performance quilt. When you compare some of the momentum representatives, I mean, you can see it kind of tends to be a little bit streaky. But even just using a broad representative like MTUM, right? The more classic, I guess, how does that differ for those listening? Something like MTUM is a more classic academic approach that differs slightly from some of the approaches that we look toward. Is that fair?
Yeah, that's totally fair. So I think the two biggest differences in what BlackRock's doing, like in MTUM, and then what we wind up doing with our Dorsey Wright stuff, is one, the calculation method. So they tend to use kind of the standard academic definition of like kind of a period to period. So they're not doing like 12 minus one, but it's similar to that. So, just looking at some price performance over certain periods. And then the second thing is they'll take like the top, and securities. I think it's the top third or whatever, and then they cap weight it, right? So we do it differently. We're looking at point and figure relative strength. That kind of takes into account really, the entire journey, right? So I always think about these kind of point to point measures as just the beginning and the end, and it doesn't matter how you get there. But with point and figure, it does, right? So there can be a lot of volatility in between those 2 points. point and figure will capture that. It does require a lot more data and things like that, but that's what like we're set up to do here at Dorsey Wright. So it's not like a big deal. And then the second thing is we tend to either equal weight or factor weight things. Cap weighting, and right now this is not true because cap weight has been so far superior over the last couple of years to equal weight or any other kind of weighting scheme. But generally speaking, over long periods of time, these kind of equal weight methods or a factor weight method tend to do better than just like a cap weighted method. And by factor weight, we mean the better momentum you have, the bigger the weight you get in the strategy.
Gotcha. So instead of having just NVIDIA, Apple, Microsoft make up 30% of a particular index, you'll maybe they will, maybe they won't, maybe some other areas with a little bit more recent pop might make up a little bit more. Is that kind of what it's looking like?
Yeah, and we'll probably have more of a skew like in the mid cap area, in something like DWA Technical Leaders Index, because since we're not doing it on a cap weighted basis, right? Like we just don't tend to skew towards mega cap, and if you cap weight, you tend to skew that way.
That makes sense. That makes sense. And so for, I guess something like that, I mean, how often is something like that evaluated? How often? What do you think of an ideal evaluation frequency is for our setup?
Yeah, I mean, so a lot of the indexes we have them set up to do it quarterly, and I think that's totally fine. You can do it on a more frequent basis, but I think the big thing is you need to know kind of going into it how often you're going to examine this, whether it's a complete rebalance, whether it's just a couple things coming in and out or whatever, and kind of match that, match how frequently you're going to do it with the kind of method you want to move things in and out. So when we do it quarterly, we can just make wholesale changes to the index. We can rebalance the entire thing and just go for the next 3 months. It's not a big deal. But if you're going to do it, like if you're going to look at it every week or say every month, it gets really expensive in terms of trading costs and slippage and all that other stuff if you're going to rebalance the whole thing. So that's why you'll see us doing in something like our indexes, we might have a quarterly rebalance and we'll change the whole thing. And that doesn't mean every security changes, but basically you're just recalculating the whole index from scratch each time. Whereas something like FV, for example, right, that's a more active model on the site, we're looking at that kind of basically every other week. So there's not changes every other week. So a lot of times you don't do anything. And if there is a change, it's kind of like one thing coming out and one thing coming in. We don't just go in and take the top 5 again, which would, if you started doing that, right, that really creates a lot of turnover, a lot of tax consequences, things like that. So I guess the point of all that is, the rebalance frequency isn't as concerning as matching it up with the method you're going to use with how often you're going to do it.
Right. And there are two things that came to mind when you're talking about that. I get one is having that knowledge of how often you're going to rebalance and when you're going to look at it at the onset, right? You don't want to be making those like I feel like I should take a look now, or maybe things might feel really choppy and you might feel like you need to make a change, but that's probably a lot of times the worst time to make a change. Is that right?
Yeah, I mean, I think that's right. And when we look at something like a quarterly rebalance, right, like there is a lot of chop that exists, during that 3 month period that you don't get caught up in. And I think that's really valuable. And if you do it every month and you do wholesale changes, you probably get caught up in that and you have things come out that rebound and things like that. So there's a tremendous amount of like short-term mean reversion and all of these things. And you definitely need to account for that as well as all the costs of trading and taxes and that sort of thing.
Yeah, that makes sense. And I know in some of the other testing and various strategies and stuff that we looked at, I mean, a lot of times we're looking at back testing any kind of application of our momentum or relative strength based approach. Not necessarily, obviously, you want to maximize the returns and minimize the risk, right? A lot of times, if you look at a more frequent evaluation, at least from some of the stuff, depending upon the inventory that I've looked at, you might boost the performance a little bit, but that turnover, to your point, it just goes up quite a bit. And nobody likes to see that, especially if you're not in a tax managed account.
Yeah, I mean the turnover and the training costs and that sort of thing are real. And I guess the other thing I would say is, you are kind of looking to maximize return, lower the risk or whatever. But the other thing I think that's really important too is to look at kind of different parameters around what you think is going to work and trying to find clusters of stuff that works. So sometimes, you might run a model and say you're running an ETF model and you run it with a 6.5% box size and you're getting, 13% a year. And then you drop it down to 3.25 and you're getting, 9, right? And you might automatically say, well, that 13%, that's what I should go with. But if you go out and you run a bunch of different box sizes, for example, around that 6.5, none of them, you might not get close to 13. You might just have kind of like one anomalous trade that got you there. And so looking for those clusters of returns that are similar, I think that's really important rather than just trying to go in and torture the data so that you just finally come up with like the highest return you can find. I mean, that's not really a recipe for long-term success.
Right, because then if you did that same test again in another year, maybe that's not the best one that could be
Yeah,
looking at, right?
yeah, that's right. Or if you just like replace one ticker in there, right? Like it could totally mess up the entire thing. So that's why when we're doing that, we tend to look at those clusters. We've also done a bunch of stuff with like random testing. So like, hey, if you actually didn't wind up getting Apple in the portfolio in 2003, does the strategy still work? And generally speaking, the answer is yes, if you kind of set everything up right. And it's not like some magic bullet how you set it up. It really is just kind of like common sense and knowing how these things perform over long periods of time.
That's yeah, that's definitely interesting, and something we should probably snip it and slap that on the models page. I think for a lot of people, or the
Yeah.
model builder page for a lot of people building this,
Yeah,
but always
don't
helpful stuff
don't
to keep in
torture
mind.
your model builder page, right? I
Yeah,
mean, we might want to have a limit for how many times you can test, like a certain strategy to just prevent you from doing that.
analysis paralysis is typically
Yeah.
not going to help you out, right?
Yeah,
But and
because
so
the reality is you like that's all great historically, but you're not getting that going forward, right? You're getting
right,
something you don't know, right? So the point of the back testing and whatever is to get a reasonable idea about how this should perform in various market conditions. And then going forward, there's some risk in it. There's some luck involved. It's a roll of the dice. And, if you set it up right, it should work, but it's not going to be exactly what you got in your back test.
yeah, that makes sense. So when we think about going forward, I mean, obviously there's a variety of different strategies that you run and that variety of different indicators and stuff that we have on the platform. A lot of those, I mean, hopefully have some continuity between them, right? In terms of where we're seeing strength. I think it's would be not surprise to anyone listening in that domestic equities is far and away leading most of our asset class rankings as we kick off 2025. And that theme really remained consistent throughout all of last year, right? But we probably have seen some shifts in terms of what areas are showing strength. And so maybe as we kick off the year, what are some changes that we saw in 2024 and where do things kind of sit from a relative strength perspective within domestic equities as we kick off the new year?
So I think one of the biggest things on the sector side, we've seen financials kind of creep up over the course of 2024. So that's been kind of a bigger thing. And what I'm noticing, it's not necessarily like the traditional financials that you might think about, investment services stuff, things that are kind of doing a lot of market-based stuff, maybe insurance, things like that. It's not necessarily just all the banks. There are some good banks out there, but it's might be a little bit of kind of the different stuff that people think about. And then otherwise, like we've had some fairly stable leadership at the top. So communication services has been doing really well, but something like consumer discretionary, something like technology, industrials, those have kind of moved around in that top half or top quartile, but they've been there for a long time, right? And they continue to be there. One thing I will note though is in some of those areas, we are starting to see that not the whole sector is just doing great. Like you can't just throw a dart at technology and just pick whatever and it's going to go up, right? there's starting to be more dispersion within these sectors between the leaders and the laggards. And something like technology is really being carried by a lot of the big name semiconductor stocks. And then there's a lot of like the smaller stuff that's not doing well, that's kind of breaking trend and things like that. So it's super important to go through and find that stuff that's not working and get it out of the portfolio and replace it with something strong. And then, kind of on the bottom end, the bottom end of the sector ranks has remained very similar as well. So energy being down there, real estate, healthcare, consumer staples, those sorts of things. So that from that standpoint, that stability has been very good for momentum for 2024 and then, to start 2025 as well.
That makes sense. And so you mentioned some of the smaller stuff, specifically in technology, not holding the same level of improvement that some of the other areas have. Is that theme? I mean, I feel like small caps have been lagging for a while, right? I mean, we've yet to see the default chart of like IWM break out to new highs since 2021. Do you think? But the chart itself, and Miles and I talked about this a little bit last week, but the chart itself looks a little more consistent, and it had a pretty good. I think it was IWM was up 11-12% last year. Not bad for small caps, not 25% though, right? What do you think
Yeah.
that space for small caps looks like throughout the year?
Yeah, I mean, I think like everybody else, has been waiting for small caps to catch up. And, it's tough to say whether they're going to wind up catching up or whether they're just going to kind of languish here until we get a major event. I mean, the last time we had this that I can remember anyway, where small caps were just terrible in the late 90s, and when the tech bubble burst, and it wasn't just tech, it was a lot of the large cap growth names. Even something like Colgate Palmolive, I think, had 40 times earnings or something like that. It took that major event to get the small caps going again and big caps going again and that sort of thing. So it's really tough to say. It seems like small caps want to get going and then it just runs out of steam very quickly. It would be great for all of these momentum and relative strength strategies if we could get some broadening out of the strength and get some better performance out of some of the smaller cap names in the S&P 500 or in the Russell 2000. When those names are doing well, it does make it much easier to outperform the cap weighted S&P. Right now, that's super difficult because it's just hard to get enough of these mega cap names in the portfolio unless you want to go really super concentrated.
Right. And yeah, that I think that's an interesting concept that a lot of people don't think about as much. It's not, I mean, it kind of like a sideways market at the end of the day isn't necessarily a bad thing for momentum or trend following strategies, right?
No. So yeah, if you get a sideways market in terms of the broad market benchmark, that's usually fine because generally not everything is moving sideways. So a lot of times in a sideways market, you might have like two sectors that are just ripping all year, and the rest of them are dragging it down and causing that kind of sideways movement in the broad market benchmark. So if you're doing an active strategy, you can kind of dial into that and overweight the areas that are doing well and underweight those that aren't. So yeah, it's not that kind of like sideways movement that's worrisome. It's really kind of the choppy back and forth movement that's worrisome, where you're like up 10%, down 10%, up 10%, down 10%. That's a lot harder to deal with when you're not going anywhere. But if you're just kind of drifting sideways, that's usually okay if there's not a lot of volatility. And then, hard up or hard down is usually fine too, because there's leadership and you can just position the portfolio for it.
That makes sense. And so when we're looking at the current market, I think one of the ways that you kind of look at some of the dispersion, I guess, for lack of a better term, and looking at different areas of improvement or leaders and laggards. One of the ways that we track that or is the index that you run looking at the RS spread index, right? Simply looking, well, maybe I'll let you explain it, but it's essentially kind of a way to look toward dispersion in the market. Is that fair?
Yeah, that's totally fair. So what we're doing is we're taking an index of high momentum securities and then an index of laggards, and you just every day you compare the performance of the two. Right. So when that spread is rising, the leaders are outperforming the laggards. When the spread is falling, it's a laggard rally, right? Or the laggards are outperforming the leaders. So in a healthy market, you want to see that spread rising. You want to see the leaders outperforming the laggards. And that is a really healthy time or a healthy kind of spot for momentum to be in.
And so that index is up at relative highs, kind of matching all-time highs, at least from what we're looking at on the RS spread. We'll throw the chart up on the for those following along on YouTube, but it's kind of matching the high levels that we saw from late 2022, right?
Right. Yeah. And so that's why, it's been so long for momentum to kind of get going again, which is, 2022 and 2023 were not good at all because of the big kind of the movement into energy, then back out into large cap growth. Those are the kind of movements that are really tough for momentum, but it was stable in 2024 and you saw the spread kind of go right along with it. So on the domestic side, mid and large cap, that's been really good. We're kind of bumping up there around the old highs. The small cap side, it's really come down. And it's been much more difficult on the small cap side. Hasn't performed as well in terms of the leader laggard relationship. We haven't had a significant downdraft in the spread, to start the year, but that's not the case in small caps. It's been much, much worse. The laggards are doing much, much better in that small cap area. And on the international side, both look pretty good. And the spread, though, on the emerging market side isn't near the old highs because we had a huge laggard rally when China did their big, stimulus package to essentially, goose the stock market, right? So that would cause a huge downdraft because so many of those Chinese equities were in that laggard bin, and China had been just a laggard country for a year plus. And so that rebounded nicely once those things started to get into the leader basket. So that looks good, although it's kind of not near the old highs like some of the other stuff we're talking about.
Right, that makes sense. And so on the international side, we're looking at China. We saw. I was kind of surprised, like FXI, broader large cap China outperformed the S&P in 2024 on an annual basis, which, given the performance to the last 6 weeks of the year, I wouldn't necessarily expected. But I guess you get that 2 week pop at the end of Q3, beginning of Q4. But so to your point, the strategies were underweight China at that time, but added China, and do they still have China within there? Is China kind of hanging around?
Yeah, so yeah, we've definitely seen the China exposure increase in a number of different products that we run. I always say one of two things happens when you have these big laggard rallies, right? Either they peter out and you go back to business as usual and they're back to the laggard bin and off you go, or they perform so well they start winding up in the leader basket, right? And then you start putting them into the strategies and things like that. So the latter has happened. Things have been doing well. We've seen different equities come into this different strategies that we run. When we look at a country ranking, China is up there near the top now. It had been near the bottom for a year and a half, 2 years, something like that. So definitely there's some continued strength there, and it's that was a big deal out of left field. No one was expecting that, obviously, given the market reaction to that announcement.
Yeah, that was pretty interesting. I know that I'm sure there'll be a lot of news coming on around China and other geopolitical events after we get some changes at the top of the country in a couple weeks here.
Yeah.
Then it'll be great waking up every morning and checking Truth Social to see what the market's going to do.
Oh yeah.
But when we're looking at
seeing what body of water we've renamed.
Yeah, or what country's their next state. But so generally reduced volatility, that can be kind of a good thing for the domestic equity side. When we see lower volatility in the domestic equity market, that, to your point, that choppiness is not a good thing for trend following strategies because there's just not clear trends to follow, right? I think a lot of people might not think about in looking at the fixed income space. So we don't only do momentum or trend following within domestic equities, right? Or within international equities, we do trend following across the board, right? If it has a price, we can track it and track the trend. What does it look like on the fixed income side as we kick off the year?
Yeah, it's been much more difficult, and I think there's just a lot more uncertainty in fixed income. So, for the past couple years, the fixed income market has kind of been like we would reach a consensus. Okay, hey, rates are coming down. They're going to do this over the next 6 to 12 months. everyone would kind of position their portfolio that way. And then all of a sudden we get one data point or some kind of event that just sends it just rocketing the other way. And those kinds of fits and starts have been going on for a while. If you look at like a chart of the 10-year or something, you can see like, a bunch of breakdowns, and then they, goes up, breaks out, and then goes the other way and breaks down again. So that's been pretty tough. And we'll see. I mean, as we get, I think part of the uncertainty has been, when you get a new administration coming in, and we've been, we were fighting a ton of inflation under the Biden administration, and then you get the Trump administration coming in with possible tariffs and things like that, which are incredibly inflationary, right? Like, I'm not here to debate the merits of them, but tariffs tend to be an inflationary thing. So, I think that kind of back and forth is tough for people to deal with, and people are trying to figure out what to do. So there's just been some uncertainty around there, and we'll see kind of how that all shakes out over time.
So for those that are looking to kind of track that, obviously fixed income's at the bottom of our asset class rankings, and it's been that way for a while, right? So it's not like we're seeing a lot of strength within the broader space. There still certainly might be pockets of strength within it. For something for those looking to capitalize on improving trends within any areas of fixed income, I know we've talked about before. The something like the Move Index is something that people might be able to kind of keep an eye on to see is what things might be looking like outside of just what the performance is in 2025.
Yeah, so you can use that, and it's kind of like the VIX with equities, right? It's just measuring bond market volatility, and when it's coming down and when it's low, that's much better for trend following strategies, just like the VIX is for equities. So that's something you can look at. The other thing, we have the group scores page and things like that where people can look at the strength. And if you look at that, it's kind of the equity link stuff that's doing well, converts, high yield, things of that nature. So, it's been tough to find that offset if you've got a 60-40 portfolio or something like that, like finding that 40% offset that is performing okay, that is also going to provide, some non-correlation to equities. That's been really, really difficult.
Yeah. Yeah. And I mean, not to dive into a different topic, but I'm sure that explains some of the just in ETF flows. People are looking for other alternatives outside of just the equity space and bonds to pick up something else in addition to equities, right? Because bonds really haven't been doing it for a couple of years.
Yeah, I mean, so there's been there's been searching, people have been searching for all kinds of different ways to get that kind of equity market offset or some downside protection or things like that.
Yeah. Yeah. Which I mean, if everybody jumps out, it might be the time I mean, the contrarian aspect of it might make it seem like might be a good time to look toward in the future.
Yeah, I mean, I think that's exactly right. I mean, I think people felt that way about momentum kind of at the end of 2023. I can't tell you how many calls we took saying, our model was broken and this, that, and the other. I mean, this is not, it's not our first rodeo. We know that all of these things kind of go through ups and downs. And that one, 2023, 2020, or 22, 23 was pretty long and deep stretch. So that wasn't great, but yeah, it came roaring back, and we didn't change anything. It's just you get a better market for it, and off you go.
Yeah. Well, hopefully that market keeps up through 2025. Well, with that, John, unless there's any other parting shots that you want to lead the listeners, I know we are not going to throw you out with a stock pick or ask you to pick your S&P price target, but you got pretty close earlier when we were talking before about what the bullish price objective for the S&P is.
Yeah, I wasn't too far off, so I'll pat myself on the back for that one.
There we go. Well, thanks as always for hopping in here, John, and jumping in and sharing some insights with us as we kick off the year this week. Thanks everyone for tuning in this week, and we'll be back to touch base on any action next week.